Trader Alessio Rastani joins me now on the line. Alessio, are we any closer to the end of the shutdown?
It's an interesting question, and right now there's a lot of uncertainty in the market. Certainly, there are, Wall Street Journal just recently wrote that the debate could take until mid-October, even until the 7th of October deadline for the debt ceiling. Question is, nobody really knows, and neither do I, as to how long the shutdown will last. We can see this in the market. The market has really shrugged off this whole shutdown thing. You see, yesterday, for example, the market ended up positive. It didn't really sink in any way that people thought. So the Wall Street, the markets are not taking the shutdown very seriously. However, I think most people are agreeing, including myself, that the real issue, the real threat that the market is worried about is the debt ceiling that's coming up in mid-October, October 17th.
Can you outline how the markets have been reacting so far, and is there any cause for investors to be concerned?
As far as the shutdown is concerned, we're certainly down. We're down about almost 3% on the Dow anyway, as far as stocks are concerned. But we're not significantly down that most people probably thought the shutdown was going to cause a major disturbance to the stock market. That's not happened. However, looking at the different stock markets and looking at also gold as well, I think these are important things to keep an eye on. The Dow still remains one of the weakest indexes at the moment. The Nasdaq, on the other hand, if you look at the Nasdaq, it's incredibly strong. You wouldn't think the market is worried if you look at the Nasdaq. Part of that is to do with Apple. Apple had some good news yesterday. I'm quite bearish on gold. I think that's going to eventually go ahead lower to 1,200. Having said that, things can change for gold. If the debt ceiling issue gets out of hand, if we see some kind of standoff, anything like that, if we have a repeat of 2011, in September 2011, there was a whole debt ceiling issue, and the market sank by almost 20%, if you remember, back at that time, then certainly we could have a mini disaster on our hands. But at the moment, there's no evidence of that whatsoever in the market. According to CFTC, commercial hedgers, that's the smart money, are betting heavily against the Nasdaq. Okay, many people don't know this, but I reported this only on Monday. So commercial hedgers, these are the smart money, they're the big money players out there. They're heavily betting against the Nasdaq. They're putting $17.2 billion bets against the Nasdaq. Now, why is that important? That's important because previously, whenever commercial hedgers, whenever these smart guys have betted so heavily against the Nasdaq or the stock markets, we've seen multi-week corrections and sell-offs in the market. So I would strongly urge your viewers to be very cautious being long on the markets or on stocks. For that reason, I am actually quite bearish on the stock markets. I think we are going to see, based on historical precedent, whenever commercial hedgers get so bearish, we've seen corrections, we've seen significant sell-offs. Just to name a few, the last time that commercial hedges were so negative was back in May, June of this year, September of last year, and also March of last year. Every single time we've seen the market has gone down significantly by almost 8 to 10%. So I am expecting that repeat. I'm expecting some kind of repeat of that this October. October has usually been a pretty volatile and bumpy month anyway for stocks. So it does not surprise me to see a significant sell-off in stocks. But just to bear this in mind, I would need to see a break of certain levels for this to be confirmed. For example, on the Dow, I would need to see a break of 15,000. And on the S&Ps, I would need to see a break of 1660 to confirm this. And
what is the worst case scenario if the debt ceiling is not raised?
Yeah, the worst case scenario is we'll have a repeat of September 2011, which means that, as we saw what happened in August of that year, the stock market sank, by almost 20%, just over 20% for some of the markets there. And that's going to cause huge uncertainty. Of course, don't forget that markets have a memory, so maybe they won't react as bad as they did in 2011. Sometimes markets tend to price this stuff in. But there'll still be, maybe we'll still get at least a 10% correction in stocks. Gold could see a temporary surge. In the past, it has been shown that a debt ceiling standoff can cause gold prices to go up. But I think it's temporary, though. I think gold prices are going to continue their downward trend. Fitch Ratings recently said that they expect gold to take out 1,200. In other words, they said that 1,200 is not a floor. They probably think that gold will head to $1,000. That's pretty bad for Fitch to say that about gold. But people out there should just be cautious on the long side and probably stay in cash if they're thinking about shorting the market, looking for short setups at this point.
Okay, Alessio, interesting times. Thanks for the update. And that's all we have time for now, but do check back later for more from the TV team. Bye for now.